The ICF Training and Technical Assistance team is honored to welcome you to this California Housing and Community Development training session offered through the Emergency Solutions Grant Coronavirus Relief Consulting and Staffing Services contract. I'm Chris Pitcher from ICF. I'll be hosting today's session. Today's session is entitled ESG and ESG CV Financial Management. It's my privilege to introduce today's first presenter, Rudy.
Thank you, Chris, and good morning, everyone. I'd like to thank all of you for joining us today to discuss the topic of financial management. As Chris indicated, this touches all of us. Today's training is meant to provide you with an overview of the financial management requirements that are contained in 2 CFR Part 200, or what is commonly referred to as the Super Circular. In today's session, we will provide you with a brief introduction of financial management, starting with an introduction, which will be followed by a general review of 2 CFR Part 200. Then we'll focus in on the 3 main subparts that are contained within 2 CFR Part 200, starting with federal award requirements, which are found in subpart D or subsection 300. Then we'll move on and spend quite a bit of time discussing cost principles, which are found in subpart E or subsection 400. And then we'll conclude the financial management training session by going over audit requirements, which are found in subpart F or subsection 500. In today's training, we will be introducing you to some of the basic concepts of financial management. These concepts include general requirements, internal controls, cost principles, and cost allocation, accounting systems and records, budget, cash management and invoicing, real property, supplies and equipment, single audit, and we will discuss other related topics along the way. Note that the financial management requirements are considered to be what we call cross-cutting. In other words, these requirements apply to all federal grants, not just the ESG or ESG CV grant. Because we are dealing specifically with the ESG CV funds, we have also incorporated the ESG requirements that are found in 24 CFR Part 576 and in the applicable Federal Register notices. The first question we might ask ourselves is, how does financial management apply to the ESG CV grant funds? Well, as a condition, I should say, of receiving these funds, the state of California, through the Department of Housing and Community Development, or HCD, is required to ensure that its grantees and subrecipients have adequate fiscal controls in place that are applicable to the ESG and the ESG CV grant awards, that its grantees and subrecipients have adequate capacity to be able to implement the grant awards, and that they are receiving training and technical assistance, and that financial management policies and procedures are developed and implemented not only by HCD, but also by its grantees and subrecipients. Note that the content of today's training is not all-encompassing. So, both Tyler and I will remind you of your responsibility to become familiar with and adhere to the applicable regulations in their entirety. So let's get started with the first section, which is a financial management general requirements. And in this section, we'll provide you with a general overview of financial management. And then we will move into discussing the basic elements of the uniform administrative requirements that are found under 2 CFR Part 200. We will cover the ESG-CV specific administrative requirements, which are found at 24 CFR Part 576. And then we'll round it off by going over the generally accepted accounting principles. Next slide. So what is financial management? Financial management is a process of using funds effectively, efficiently, and transparently. These three things are accomplished in part by adopting policies and procedures, which are also known as written standards. These standards describe what is to be done, as well as how it is to be completed. At minimum, the financial management written standards should incorporate the items that are represented in the graphic. And those items include regulations and requirements, should include budgeting, accounting systems and records, internal controls, cost principles, and closeout. Effective financial management systems generally contain a number of key elements or characteristics. These characteristics include written standards or policies and procedures that we just noted on the prior slide, specific or specifying the roles and responsibilities of staff at all levels, all the way from the director to the line staff. Written standards should ensure that everyone is aware of their responsibilities and that they are held accountable for ensuring that their tasks are implemented correctly, so that as a whole the program then is implemented in accordance with the regulations and requirements. Additional key characteristics include, but are not necessarily limited to, that the program records are complete, that the records are accurate, and that they demonstrate costs that are necessary, reasonable, allowable, and allocable. We always hear those four requirements when we talk about financial management, and I'll repeat them again: necessary, reasonable, allowable, and allocable. The additional key characteristics are that reports are prepared in a timely manner and that they provide useful information for all of those that are administrating the grant, and that the program funds are not just sitting unused, and that they're protected from any misuse. And lastly, that there is a continued self-assessment and an ongoing improvement of your organization's financial management systems. When discussing financial management of all federal funds, we always start with the uniform administrative requirements, cost principles, and audit requirements for federal awards. And these are codified, again, at 2 CFR Part 200. As a recipient of the ESG and ESG-CV funds, HCD, its grantees, and its subrecipients must all adhere to the requirements that are found in 2 CFR Part 200. And you're going to hear 2 CFR Part 200 throughout this training session. That is where we go to ensure that we are complying with proper financial management practices. This also requires the establishment of adequate controls and accountability over all funds, all property and other assets, and to ensure that the ESG-CV grant funds are used exclusively for the purpose that they were authorized. The requirements of 2 CFR Part 200 focus on 3 main sections, and they're shown on the table on this slide. And they are the administrative requirements, which are found at 2 CFR Part 200, or also known as Subpart D. And the key components of Subpart D include budgeting, accounting systems and records, as well as internal controls. And we'll talk about each of these in more detail in the upcoming slides. The next section, or the second row down, talks about cost principles, which is found at 2 CFR Part 200 or Subpart E. Key components of Subpart D include allowable and unallowable costs, as well as direct and indirect costs. And we will definitely do a slightly deeper dive into cost principles a little later in the session. The last section, last row, that is referenced on this slide is the audit requirements, which are found at 2 CFR Part 200 or Subpart F. And the key components of Subpart F include information on who must undergo a single audit, as well as what is the focus of the single audit. As I mentioned earlier, there are also specific administrative requirements for the ESG grant. And these are codified at 24 CFR Part 576. And with the uniform requirements being codified at Part 576.407C. These regulations set forth the applicable requirements that must be adhered to in your administration and your implementation of the ESG and ESG-CV grant funds. Note that whenever and wherever there is a conflict between the uniform administrative requirements that are found at 2 CFR Part 200 and the ESG regulations found at 24 CFR Part 576, the ESG regulations shall always govern. Two CFR Part 200 requires that HCD, its grantees, and its subrecipients adhere to the generally accepted accounting principles, which is commonly referred to as GAAP. The GAAP refers to a common set of accounting principles, accounting standards and procedures that have been adopted by the U.S. Securities and Exchange Commission, or the SEC, and are published by the Financial Accounting Standards Boards. The GAAP provides commonly accepted ways of recording and reporting accounting information for all federal grants, and that includes the ESG grant, the ESG-CV grants that you have received. The objective of the GAAP is to improve the clarity, the consistency, and the comparability of financial information. In other words, a general ledger should contain specific information, and it should be the same whether that general ledger is for the state of California or the state of Alaska should contain the same information. We should be able to compare the information from one to another and ensure that the information is contained in both. So what are the takeaways from the general requirements section that we just discussed? We can start by asking ourselves, does my organization, as well as any subrecipients that I may have funded, have written policies and procedures or written standards that govern the financial management process and the financial systems? Ask ourselves, are the written standards current? And are they compliant with 24 CFR Part 576 and 24 CFR Part 200? Next, we'll move on to the federal awards requirements. And in this section, we will discuss budgeting, accounting systems and records, internal controls, real property, equipment and supplies, and what I always say is everyone's favorite, procurement. For the purpose of the ESG CV grant, a budget occurs at several levels. You can say that it starts with HCD at the point of the action plan approval. HUD requires HCD to include in its action plan a single chart or a table that illustrates at the most practical level how all of the ESG CV grant funds are budgeted. The action plan budget is entered into HUD's Integrated Disbursement and Information System, or IDIS. In addition, HCD must establish an operating budget for its program. Grantees and subrecipients will also establish their own operating budgets based on standard agreements with HCD. And we'll be discussing budgets in more detail 2 slides from now. Yes, thank you. Prior to dispersing any ESG CV funds to grantees or subrecipients, HCD must prepare and execute a written standard agreement with each of its grantees or subrecipients. The standard agreement must contain the 4 items that are listed here on this slide, and they include a project description or scope of work, the period of performance, a sources and uses budget, and it must also include performance measures. The agreement remains in effect during the period of the grantee or that the grantee or the subrecipient has control over those ESG CV funds, including any program income that may be generated by the program. The 4 items that are listed on the slide must be in sufficient detail to provide a sound basis for HCD to effectively monitor performance under the agreement. Likewise, grantees that are utilizing the services of a subrecipient, they must also have executed agreements with its subrecipients in carrying out the ESG CV activities. Grantees or subrecipients shall also be responsible for making sure that the ESG CV award is incorporated into their operating budget. An operating budget generally includes, but is not limited to, the items that are noted on this slide. And some of those categories would include salaries and wages and other personnel costs, professional fees and services, rent, and capital expenditures, just to name a few. Next, we'll discuss accounting systems. So HCD, its grantees and subrecipients must all set up and maintain an accounting system for the ESG and ESGCV grant. The accounting system must identify and separately maintain accounts for each federal award by unique identifiers. As an example, the unique identifier could be the subrecipient's agreement number and the year that they received the grant funds. They must also distinguish costs by budget category and differentiate between direct costs and indirect costs. And again, we'll be discussing the difference between what direct costs and indirect costs are a little later in this training session. The accounting systems that are utilized must provide accurate and the most current information, and must present a complete disclosure of the financial transactions of each grant at both the summary and the detailed levels. And it must allow for the comparison of expenditures with the budget amounts for each of the federal awards. So on the prior slide, I indicated that HCD and its grantees and subrecipients, they are all required to maintain separate accounts for each federal award by unique identifiers, right? So on this slide, we're providing you with examples of what a compliant and a non-compliant accounting system would look like if it received ESGCV funds from not only HCD, but from another entitlement grantee. The compliant example, which is the first two rows on this slide, shows the state ESGCV grant and the entitlement ESGCV grant separately identified. Basically, it's their own bucket, with accounts being maintained separately. In comparison, the example that is represented in the bottom row shows both state and entitlement grants that are commingled into one bucket. This particular accounting system is not compliant. HCD and its grantees and its subrecipients are required to maintain records that clearly identify the sources and uses of the grant funds. The records that must be maintained include information regarding the grant award, authorizations, obligations, or encumbrances, should include unobligated balances, assets, expenditures, and if applicable, any program income, and finally, any interest that may be generated as a result of these, the ESG or ESGCV grant funds. All costs that are allocated to the ESGCV award must be supported by source documentation, including any procurement actions, invoices, and all payroll records. The next item that we'll be discussing is accounting records. In all of our trainings, we inform you that the three most important things about grants management is the first thing, documentation, the second thing being documentation, and the third thing being documentation. With this in mind, it's important to remember that all accounting and all accounting entries that appear in your general ledger must be supported by source documentation. Goes back to documentation, documentation, documentation. The source documentation must demonstrate that the costs that have been charged to the grant were incurred during the effective period of the standard agreement, that they were not incurred prior to or after the effective date, that the costs were verifiably paid out or that they were adequately approved, that they were spent on eligible costs and that the costs were within the approved budgets under the agreement, and that the costs were approved by the appropriate official or officials within your organization. Note that as part of the standard agreement, HCD has the right to access any and all of the grantee or subrecipient's financial records that are pertinent to the ESG or ESGCV grant funds. These financial records generally need to be accessed for the purpose of conducting a programmatic monitoring or a fiscal audit of the grant. And they also may need to be accessed by HUD and or OIG. One of the most important elements of a sound financial management system is internal controls. Internal controls are designed to minimize the misuse of the grant funds and of poor record keeping. Internal controls also are designed to maximize the likelihood of detecting problems if they are occurring. This is generally accomplished by preparing and adopting a well thought out written standards that describe what is to be completed and how it is to be completed. We've said that a couple of times now in this training session. So keep reminding yourself that these written standards describe what is to be completed and how it is to be completed. At minimum, the internal controls, the written standards should incorporate the regulations and requirements. It should incorporate separation of duties, which we've just discussed, monitor and evaluate compliance, taking prompt action in instances of non-compliance, and it should incorporate, the reasonable measures to safeguard protected personally identifiable information, or PII. When we are establishing internal controls, we start by instituting separation of duties. The requirements for separation of duties is meant to prevent fraud, waste, and abuse of the grant funds from taking place. a well-designed internal controls prevent a single person from having authority to approve a transaction, to execute that same transaction, record a transaction, and to have custody of any of the resulting assets. So on this slide, what we have done is we've provided you with an example of clear separation of duties over a specific transaction. In this example, we're using procurement as the example. So we start with person A, and person A develops and issues a request for proposal. Then moves on to person B, who reviews the proposal or the RFP and makes a recommendation for the award. Person C reviews and authorizes a contract with that selected bidder. Person D then prepares a contract or the contract provisions and the budgets. Person E then reviews and recommends payment of any of the contractor invoices. And finally, person F reviews the invoices and issues payment to the contractor. Note that it is understandable for smaller organizations not to be able to have, the luxury of 6 different people or 6 different staff members performing the multiple transactions. So I want to make sure that you understand the key takeaway of this slide of separation of duties, and that is that your written standards should be such that your separation of duties prevent against fraud, prevent against waste and abuse of your ESG-CV grant funds. The second item that we will look at when establishing internal controls is monitoring and evaluating compliance. HCD and its grantees and subrecipients must ensure that they have adequate procedures in place that include how they propose to track expenditures on a monthly basis, how they will monitor the expenditures of its grantees or its subrecipients or even contractors, how they propose to account for and manage any program income that may be received through the program, how they will reprogram any grant funds from any stalled activities and how they will do so in a timely manner, and how they will forecast expenditures to ensure that they're able to exhaust all of the ESG-CV grant funds within the period that has been stipulated in the grant agreement or in the standard agreement. In addition, grantees and subrecipients are also required to expend funds in a timely manner in order to avoid the recapture of the grant funds by HCD and or HUD. If under the standard agreement that you entered into, the acquisition of real property is being permitted for a temporary emergency shelter, the title for that property, the property that is acquired with the ESG-CV grant funds, it must be vested upon acquisition by the grantee or the subrecipient. Any real property that is acquired for temporary emergency shelter must be used for that purpose for which it was originally authorized. In addition, the property can only be disposed of in accordance with the requirements that can be found in 2 CFR Part 300, and that would be subsection 311. And lastly, any real property for which ESGCV grant funds were utilized for the purpose of rehabilitation, for conversion, or any other type of renovation, it must comply with the minimum period of use requirements that is found under 24 CFR, I'm sorry, Part 576, subsection 102. Now we'll move on to discussing supplies and equipment, and we'll discuss what the difference is between the two. So under 2 CFR Part 200, subsection 1, which is where all of the definitions are in the super circular, we find the word equipment and supplies. And equipment is defined as any tangible personal property having a useful life of more than 1 year and a per unit acquisition cost which equals or exceeds the lesser of the capitalization level established by the non-federal entity for financial statement purposes, or $5,000. And that number, by the way, has not changed in many, many years. Supplies, on the other hand, is defined as tangible personal property other than those described in the definition of equipment that I just read. And so if it is not equipment, then you can classify it as supplies, and that's basically what that definition is saying. For more detailed information on equipment, I refer you to 2 CFR Part 200, subsection 313, and subsection 314 for supplies. These two sections will provide you with more information on how to manage and dispose equipment or supplies that you may have purchased with the ESGCV funds. As we show in this graphic, procurement is a multi-step process for obtaining goods, services, or supplies from potential contractors or vendors. The graphic shows the basic steps of the procurement process, which includes, on the very first step, the preparation of an internal cost estimate. And the internal cost estimate will be used, or is used, in your evaluation process to ensure that the bids that you received are reasonable. In step 2, we have the solicitation of bids in accordance with one of the methods that is listed in 2 CFR Part 200, subsection 320. And we'll be discussing those various procurement methods actually in the next slide. Step 3 is the review or evaluation of the bids for compliance with the procurement method that we selected. And again, we'll talk about that in the next slide, as well as to ensure that the bid is reasonable. And you're going to hear that a lot. You know, is the cost reasonable? Is the bid reasonable? And when we get into cost principles, we'll talk a little bit more about cost reasonableness. And step 4 is the awarding of the contract. So all of this, so what is the purpose of procurement? And so the purpose is really to promote equitable purchasing standards, to ensure a fair treatment, equitable treatment of proposers and prospective proposers in accordance with the rules that are applicable to each procurement method, and to ensure that the costs or the price for the goods, the cost of supplies or services, again, are reasonable. HCD and its grantees and subrecipients are required to follow and to document one of the procurement methods that is noted on this slide. And so what we have done is we've broken it out into the two basic methods that are applicable under 2 CFR Part 200, and they are the informal procurement method and the formal procurement method. So we have two buckets there. Under the informal procurement method, you have two options available to you, and they are the micro purchase process and the small purchase process. Under the formal procurement method, you also have two options available to you, and they are the sealed bid process, and this is the most common for construction type projects, and the competitive proposal process. Each of these methods of procurement includes specific procedures for the contract award and its uniqueness to the process that was followed. As mentioned in the prior slide, the four procurement methods are further described in 2 CFR Part 200, subsection 320. Each grantee and subrecipient agreement includes requirements, and it also includes provisions for procurement of non-personnel costs. This includes providing HCD with evidence, documentation, remember, documentation. So you need to provide HCD with evidence that one of the procurement methods was used and has been fully documented. As part of the procurement process, ensure that you are evaluating the bid offers that you have received. That evaluation should include a review to determine if the bidder is responsive and responsible, and is the bid reasonable? So remember that costs are considered reasonable if they do not exceed what a prudent person might incur under similar circumstances. As with all financial management items, again, you must document your procurement process and the results of that process. HCD, its grantees, its subrecipients must maintain specific records. And so on this slide, we have provided you with a list of records that you need to maintain in your procurement files. And these would include the solicitation documents that you used in the procurement process. This would include the user request, the scope of work, any evaluation criteria, and the terms and conditions for that solicitation. It should include documents or records that show your evaluation, your recommendations, and your determinations of the bids that you received, any and all advertising that was used when you conducted the procurement for the goods and services. And if applicable, the advertising documentation should include language or documentation on your requirements for MeBe-WeBe, for Davis-Bacon and related acts, or DBRA, and Section 3. You'll also want to maintain any documents or any information that was requested by the bidders, information that was considered or received as part of the procurement process. So again, includes questions or comments that you may have received, and any responses that were provided to those questions and or comments. And finally, you must maintain copies of all offers or bids received as part of that solicitation process. So when discussing federal award requirements, we also need to consider some other related topics, and this includes closeout, and that can be found at 2 CFR Part 200, subsection 331. We want to consider anti-fraud, waste, and abuse requirements, which are in the Federal Register notice. The records retention and access requirements, which again are in 2 CFR Part 200. Contracting with minority and women-owned businesses, again, part of 2 CFR Part 200. And Section 3 requirements, which are in 24 CFR Part 135. And I'll add one other, and that is Davis-Bacon, if that is applicable. So what are the takeaways from the federal award requirements section? Well, we can start by asking ourselves, does my organization or do my grantees and subrecipients have adequate accounting systems in place to document compliance with 2 CFR Part 200? Does my organization or my grantees or subrecipients have adequate written standards that include internal controls and separation of duties, that includes real property, equipment, and supplies? Does it include the procurement process and any other requirements that are applicable to the grant and your agreement? I will now be turning it over to Tyler Bridges, who will be presenting the cost principles section of the training. Tyler?
Yep. Thank you, Rudy. So next we'll talk about cost principles, which include necessary and reasonable costs, cost allowability, cost allocability, and direct and indirect costs. So the cost principles at 2 CFR 200 govern all costs charged to and reimbursed by the ESG CV award. In summary, cost principles require all costs to be necessary and reasonable, allowable, and allocable. So first, let's review the requirement that costs must be necessary and reasonable for the performance of the ESG CV award. A cost is considered necessary if it is essential to ensure proper and efficient performance and administration of the ESG CV award. For example, the purchase of iPads using ESG CV funds because they are convenient would not be considered necessary in and of itself, especially if iPads are not used for other similar operations within the agency. A cost is considered reasonable if the cost does not exceed what a prudent person would incur under similar circumstances. Using the same example, the purchase of iPads using ESG-CB funds would not be reasonable if less costly tablets can perform the same intended purpose. To determine if a cost is reasonable, the cost must pass the rational person test by meeting all of the following criteria. The cost is recognized as ordinary and necessary for the operation of the organization and or ESG-CB funded activity. The cost is in accordance with market prices for comparable goods or services as evidenced by cost estimates and documentation. The individuals responsible for incurring the cost acted with prudence and for the benefit of the organization and its activities. And finally, the cost has been incurred after following the established practices of the organization in accordance with the terms and conditions of the ESG-CB award. So next, let's review cost allowability. A cost is allowable to charge to the ESG-CB award if the goods or services involved, 1, conform to limitations or exclusions set forth in the standard agreement, including the types and amounts of costs, for example, personnel costs or equipment purchases. 2, are consistent with policies and procedures that apply uniformly to costs allocable to both the ESG-CB award and other non-ESG-CB sources. 3, are accorded consistent treatment. This means a cost may not be assigned to the ESG-CB award as a direct cost if any other cost incurred for the same purpose in like circumstances has been allocated to the ESG-CB award as an indirect cost. And finally, they should be adequately documented. Further, the total costs charged to the ESG-CB award are the sum of the allowable direct and allocable indirect costs minus any applicable credits. An applicable credit includes discounts, rebates or allowances, recovering for or indemnities on losses, insurance refunds, and adjustments of overpayments or erroneous charges. So let's look at an example. If a grantee is implementing a homeless shelter program and purchases a new air conditioning unit for $8,000, but received a $1,000 rebate from the manufacturer and had $500 of program income on hand, then the request for funds, or RFF, of HCD would be $6,500, which equals the cost of the air conditioning unit at $8,000 minus the $1,000 manufacturer rebate and the $500 in program income on hand. There are also certain additional limitations to cost allowability. First, any cost incurred in excess of the budget amounts by eligible activity in the standard agreement are not allowable to be charged to the ESG-CB award. Second, the ESG-CB regulations contain caps on the amount of funds that can be used for specific purposes. For example, HUD limits the amount of funds that can be spent on administration expenses to 10% of the grant award. The uniform administrative requirements at 2 CFR 200 further allow HCD to limit administrative expenses incurred by grantees below the 10% threshold, with the remaining funds reserved for HCD's administrative expenses. Finally, as a reminder, there are certain caps under the annual ESG program for street outreach and emergency shelter that do not apply to ESG-CB funds. So staying on the topic of cost allowability limitations, cost must also conform to any limitations or exclusions set forth in 2 CFR Part 200 and the ESG-CB requirements and regulations as to the types or amount of cost items. For example, 2 CFR 200 contains a list of allowable costs, such as payroll costs, equipment, etc. If a discrepancy exists between the list of allowable costs at 2 CFR 200 and the allowable costs for the ESG-CB program, then the regulations and requirements for the ESG-CB program at 24 CFR 57 and CPD Notice 21-08 apply. Costs must also be consistent not only with the standard agreement, but also the policies and procedures that apply uniformly to both the costs incurred for the ESG CV award and other costs incurred by ESG CV grantees. For example, if the state per diem allowance for travel exceeds the federal per diem limits, then the stricter requirements apply. So in this case, the federal per diem limits are stricter and therefore prevail. Further, and we'll be discussing this in more detail in just a few moments, all costs must be afforded consistent treatment to be considered allowable. This means that a cost cannot be assigned to the ESG CV award as a direct cost if any other cost incurred for the same purpose in like circumstances has been allocated to the ESG CV award as an indirect cost. So here we see examples of allowable costs by cost type. First, project costs are costs incurred to provide the activity or project. For example, rehabilitation of an emergency shelter. Activity delivery costs are costs incurred for the implementation, management, or oversight of a particular project or activity. For example, intake and eligibility screening of applicants or beneficiaries. Both project costs and activity delivery costs are allocable to the eligible activity budget. Administrative costs are costs incurred for the implementation, management, or oversight of the project or activity and are subject to the administrative cap. Finally, certain costs are also expressly prohibited or unallowable. Payments made for costs determined to be unallowable by HUD or by HCD, either as direct or indirect costs, must be refunded, including interest, to HCD and or HUD. Examples of types of costs that are unallowable include assistance to ineligible program participants, activities not allowed under CPD Notice 21-08, and political activities. Payments made to a grantee may be recaptured if they exceed the maximum allowable rates, are not allowed under applicable laws, rules, or regulations, or are inconsistent with the standard agreement. So next, let's discuss cost allocability. Every cost incurred for the performance of the ESG-CV award must be allocated as either a direct cost or an indirect cost. There is no universal rule for classifying certain costs as either direct or indirect under every accounting system. A cost may be direct with respect to some specific service or function, but indirect with respect to the ESG-CV award. Therefore, it is essential that each item of cost incurred for the same purpose be treated consistently in like circumstances, either as a direct or indirect cost, in order to avoid possible double charging of federal awards. So a cost is allocable to the ESG-CV award if the goods or services involved are incurred specifically for the ESG-CV award. This would be considered a direct cost, or benefits both the ESG-CV award and other work of the grantee and can be distributed in proportions that may be approximated using reasonable methods, or is necessary to the overall operation of the grantee and is assignable in part to the ESG-CV award, and this would be an indirect cost. The uniform administrative requirements also define unallocable costs. Any cost allocable to another federal award other than the ESG-CV award may not be charged to the ESG-CV award to overcome funding deficiencies, to avoid restrictions imposed by federal statutes, regulations, or terms and conditions of the other federal award, or for other reasons. This prohibition, however, does not preclude grantees from shifting costs that are allowable under the ESG-CV award and other federal awards in accordance with existing federal statutes, regulations, or the terms and condition of the federal awards. So let's look specifically at direct costs. Direct costs are those costs incurred specifically for the ESG-CV award and are not otherwise treated as indirect costs. Examples of indirect costs include payroll costs incurred to administer the ESG-CV award, supported by timesheets and payroll records detailing the date and time the employee worked on the ESG-CV award, costs incurred by grantee subrecipients performing services solely for the ESG-CV award, the purchase of supplies and equipment used solely for the ESG CV award, and direct awards to eligible ESG CV beneficiaries for eligible ESG CV activities. So the following illustrates an example of differentiating direct costs from indirect costs. Starting from left to right, if staff member A is fully dedicated to the ESG CV award, then 100% of their salary and fringe benefits, such as healthcare, etc., are allocable to the ESG CV award. Likewise, if staff member B works on ESG CV and another federal grant, the employee's payroll costs can be split on a pro rata basis using their hours spent on the ESG CV award and the other grant as documented on their timesheets. Costs incurred by grantees' payroll and human resources departments, however, are indirect costs, since these departments process payroll or provide services for all of the grantee, not just the ESG CV award. So let's look at indirect costs in more detail. Indirect costs are costs incurred for a common or joint purpose benefiting more than just the ESG CV award and not readily assignable to the ESG CV award without first determining the amount that can be reasonably charged to the ESG CV award. Example indirect costs include rent and utility costs, accounting and administrative staff, internal auditing costs, motor pools, and computers and software. For a grantee to charge indirect costs to an ESG CV award, their standard agreement must require that one of the three indirect cost methods are followed and documented. The three methods are the 10% de minimis rate, a negotiated indirect cost rate agreement or NICRA, or a cost allocation plan. Each standard agreement also includes requirements and provisions for charging indirect costs. If a standard agreement allows for indirect costs, grantees must first submit supporting documentation for one of the three methods to HCD and receive written approval prior to requesting reimbursement for indirect costs. So this wraps up our cost principles discussion. The following are questions or key takeaways. One, are applicable staff of my organization and my subrecipients, if applicable, adequately knowledgeable of necessary and reasonable requirements, and which types of costs are both allowable and allocable? And two, does my organization and my subrecipients, if applicable, plan to charge indirect costs? And if so, has all required supporting documentation for my organization been submitted to and approved by HCD? And with that, I'll turn it back over to Rudy.
Thank you, Tyler. So we're now on the home stretch of today's financial management training. In this last section of the training, we're going to be discussing single audits. And so we can start the discussion of single audits by asking the question, who must undergo a single audit? So 2 CFR Part 501A, 200 Part 501A requires that any non-federal entity that expends, and that being keyword, expends $750,000 or more during the non-federal entity's fiscal year. So two key elements: expends during the entity's fiscal year. If they expend more than $750,000 in federal awards, they must have a single or program-specific audit conducted for that specific fiscal year. Therefore, all ESG CV awardees, and this includes HCD, its grantees, its subrecipients, that meet this threshold during its fiscal year, they must undergo a single audit, and it must be conducted in accordance with the scope of audit requirements that are listed in 2 CFR Part 200, subsection 514. The single audits primarily focus on financial statements and records. It focuses on internal controls and compliance with the requirements of the federal grant, which in this case would be the ESG CV grant award. Grantees and subrecipients will need to provide a copy of the results of the single audit to HCD as required under the terms of the standard agreement. And it's a short session. It was one slide. So we have a quick takeaway. So the single audit takeaway, when we're addressing single audits, we need to ask ourselves, did my organization or my subrecipients expend $750,000 or more during the last fiscal year in federal awards? And so if the response is yes, then was a single audit performed for the last fiscal year? Also, you'd want to ask yourself, will a single audit be triggered for this fiscal year so that you can start preparing for that? That concludes our presentation for today on financial management. I will now turn it back over to Chris for some closing statements. Chris.
Thank you, Rudy, and thank you, Tyler, for that financial management conversation today. And thank all of you for attending this California Housing and Community Development training session offered through the Emergency Solutions Grant Coronavirus Relief Consulting and Staffing Services contract. Please note that this training series features over a dozen sessions that you can view at your leisure.